Well, as Steve does that, good morning, everyone. Welcome to today's Coffee Talk session. My name is Sean O'Brien, president of QuickRate, and as always, I'm pleased to be joined by Steve Huntington. Steve, you want to go ahead and introduce yourself?
Yeah, thanks again, everyone, for joining us. It's been a hot minute since we've had y'all with us on a Friday morning. My name is Steve Huntington. I'm a director of analytics here at QwickAnalytics. Spent my whole career working with community banks around the country, and spent more than half of that time now working with Sean at QuickRate.
Thank you, Steve, and we're very pleased, as always, to welcome back our dear friend Paul Allen from Saltmarsh. Our best coffee talks, I think, are when Paul joins us. Paul, you want to go ahead and introduce yourself?
Well, good morning, everyone. My name's Paul Allen. I'm a director with Saltmarsh. I get the opportunity to work with bankers and credit unions all across the United States, and really enjoy, especially talking with everyone about CECL and this brave new world. So, Sean and Steve, thanks for having me.
Of course. Again, thrilled to have you, and thanks for joining us for today. Just a couple of reminders. We are, in a muted session when you enter. If you have questions throughout, as you all know, go ahead and use either the chat feature or the Q&A box. We'll monitor those and either take the questions at an appropriate break or at the end, or I'll simply interrupt Steve, which I've done before.
Feel free. Needs to be done sometimes, Sean.
And get those questions answered at hopefully an appropriate time or break in the conversation. As always, too, we have a few polling questions to get us started. And before I do that, just a reminder, we will send out a link to today's recording and a copy of the slides and the results of the polling questions. So those will likely, go out Monday morning. So thank you for registering and thank you for participating in the polling question. So here we go. Just 5 of them today. So we'll get started. Many familiar questions. Are you seeing any increase in your past due loans? Yes, no, or about the same. We'll just give this 30 or 45 seconds and then move on to the other questions. Okay. 39% about the same, 33% are seeing an increase, and 28% are not seeing any increase. So thank you again. Let's move to the next question around Q factors. Have your Q factors increased, decreased, or stayed the same this year? Uh, 54% have seen their Q factors stay the same, 39% have seen an increase, and 7% have seen a decrease. So thank you as well on that one. Let's move to the allowance, kind of a similar question. Has your allowance for credit losses increased, decreased, or stayed the same so far this year? Similar numbers here. 47%, excuse me, have stayed the same. 38% have seen an increase, and 15% have seen a decrease. Just down to the final 2 questions. Now, regarding exams, have you undergone an exam for CECL? And for many of you, and sorry, there was a follow-up question. And if so, how have your auditors responded to your implementation? Positively, mixed, or the final one there is critically, significant changes to policy or ACL levels suggested. Okay, so let's take these. So in the first question, 82% of you have gone through an exam. For those of you who have responded, It's 82% positively, 15% mixed, and 3 critically. So again, thank you for sharing. Whoops, I didn't share those results. There you go. Thank you for participating in those polling questions. And again, we will make the results available in our follow-up email. And the final question here regarding an audit. Have you undergone an audit of your reserves for CECL? And then secondly, if so, how have your auditors responded to your CECL implementation? Again, positively, mixed, or critically. Okay, let's go ahead and end that one. So 79% again have had an audit of your reserves. 82% have had a positive reaction regarding your implementation, 17% mixed, and 16% have not gone through an audit. So again, thank you all very much for answering our polling questions. And with that, we will get kind of get moving here and turn. When we have Paul on, we want to make sure we get his thoughts and his perspectives on what he's seeing in the course of their audits and discussions with banks. So I'm going to turn it over to Paul, and Paul, we'll get your thoughts. As we've moved from implementation to kind of management of CECL.
Well, thanks, Sean. That's exactly where we are. Was interested in the last two questions. By now, community banks having adopted CECL in the previous year, we would have expected that everyone would have had at least one exam and at least one external audit. And so far the implementation is in the rearview mirror. We're all on the CECL process. We're working through that. Most of the drama and excitement of the first time through the model has diminished a little bit. And so we wanted to talk a little bit about what do we do now. As with anything, if you remember any of the things that we've gone through as a major change in regulation or accounting standards, there's a lot of drama and implementation, and then we have to move into ongoing maintenance. And so I wanted to just talk a little bit about that. When you have an exam or an audit, that's the external auditors or the regulatory examiners looking at your model, but they expect you, management, to have done a model validation. And so this is really looking at the data inputs. Are they correct? Are they mapping correctly? Your assumptions, your output, your governance over the process, and so forth. And so if you haven't yet had a model validation, typically all models that we use, whether it's BSA or interest rate risk, or in this case, CECL, all models have to undergo a periodic independent model validation. And so I would expect, Sean, that most everyone's probably done this. Usually when you implement a model, you have a validation within about 6 or 9 months after you implement, give you a chance to get it going, go through the process a little bit, and then check back. And then on an ongoing basis, the guidance would suggest that every time you change models or make a significant change in the way you run the model, then you would probably look at a validation. Otherwise, a lot of models we do every 2 or 3 years. I think with CECL right now, there's almost an expectation or an anxiety about the process. So I think a lot of banks are still are sort of planning a model validation every 12 to 18 months. The problems that are coming up right now are that second bullet point, and that is the mapping. I admire so much the bankers and the folks in our industry. They worked really, really hard on getting CECL implemented, and that was a huge mapping effort to map the right loans and the right loan types into the model, the data. But I just would remind you that changes all the time. You might have a slight change in in your software applications or a subset of the software processing and so forth. And you may offer new products or products with different features. And so we are seeing a little bit of oops, if you will, as we go forward. And so I'd encourage you to be thinking about, what is my mapping process? At least probably once a year, management should do at least a test on a sample of the inputs and make sure they're coming for the right places and so forth. And so this is an area that, we spend so much time, Sean, doing it on implementation. And so it's like set it and forget it. Well,
Yeah.
with mapping it, it's not going to be set it and forget it. We're going to have to actually take a look at that. And in the same way, the economic factors are changing. Sean, I heard there's some kind of news about the economy going on in the last couple of days. Uh, before we went through this big new issue of today with tariffs, there were already some cracks in the credit cycle. There were already some of our metrics moving up, past dues, delinquencies, and so forth. So, as we go through uncertainty, we can't predict what that future is, but we certainly need to be on top of and be flexible and ready to look at those economic factors and see if they need adjustment. So I was curious on the survey results. We had over half didn't change qualitative, but the allowance went up. Well, was that pure growth, or was that we had a little bit more charge-offs in some elements? So, I just encourage you to be looking at that. And that's really kind of some bullet points on that next slide, just in terms of credit risk. We have been talking about, Sean, how long has it been? How long have we been talking about? Boy, this credit cycle has got to turn down. And yet, we have, as an industry, been blessed with very low charge-offs historically. We're starting to see a little bit of a change in the asset quality metrics. I encourage you to watch, the FDIC quarterly release, as well as the Kansas City Fed and the Atlanta Fed and the St. Louis Fed all put out really good, metrics and information about credit risk. And Sean and his team on the credit side can give you a lot of information too, and background of what they're seeing among their clients as well. But right now, a lot of our provision or allowance is on qualitative factors. And so we're going to have to be ready to move that as charge-offs slightly increase. Are you going to keep your qualitative the same? Or are you going to offset that a little bit? So I would be having a robust dialogue on a quarterly basis with the management team and looping the board in about, what are we going to do as the uncertainty settles down or continues? What happens if the asset quality metrics continue? Where do we start measuring that the credit cycle perhaps has turned a little bit, and what should we do about that? So, Sean, do you agree with me? My basic premise,
Absolutely.
I think we're seeing some deterioration.
Yeah, I don't think there's any question. We've talked about it for a long time. I think certainly over the last 12 months, we've seen, as you pointed out, right, not necessarily a huge uptick in charge-offs, but certainly in delinquencies and past dues. I think we've definitely seen, a rise there. What happens from here? Hard to say, but I know in our in our little bank where I'm a director in Illinois, in our exit exam, right? I think even the OCC acknowledged, right, that they're seeing the uptick in past dues. Certain areas, obviously, they're more sensitive to than others, but there's no question they're sensitive to it because they can just see overall. Where again, nothing's risen to the level of charge-offs, but there's certainly heightened concern in showing weakness with some of the metrics.
It's going to be really interesting to see where the regulators' expectations head in the future if these past dues start to materialize into being charge-offs. With a recent history of negligible charge-offs and a reserve requirement, which is funny, just about 125, which is where it was before this whole shebang with CECL started. If we're at 125 reserves when there's zero charge-offs, Is the expectation that we're all going to be at 150 of reserves when there's 25 basis points charge-offs? Because again, CECL, the whole concept is our 125 of reserves now is supposed to take into account losses over the remaining lives of the assets, including potentially weaker economies with higher losses in the future that we have not yet seen. So technically, from an accounting standpoint, the argument I'd expect to be hearing more is just because some of those losses are being realized now, we shouldn't expect to necessarily see an increase in reserves across the board if they were already anticipated and built into our reserves. Now, that's all well and good, but our examiners hold the keys to the kingdom, and if they feel that the reserves need to go up despite that fact, then that's probably the direction they will be headed.
Yeah, and Steve, I think one of the concepts that they're going to stand on is that when you do see an increase in charge-offs, that typically is an indicator of economic weakness in the rest of the economy or parts of the economy. So I think what they're going to, kind of question you, and you should be ready to talk about as a management team, is just because we've had an increase in charge-offs, does that necessarily change our outlook for the remainder of the loans over the remainder of the life of the portfolio? So, it's going to be a delicate balance. We've talked all through the first part of implementation of CECL that since there's been such low charge-off history, it's all qualitative. And as we start to get charge-offs, qualitative would theoretically go down. But as you know, whenever we have big increase in charge-offs, the economic factors hurts the economy for a short period of time before we get to stabilization. So, it may be a bumpy ride. Now, we don't want anyone to walk away with either, oh my God, I better double my reserves, or paralysis by analysis. What we'd like to propose to you is that management team should be having a healthy discussion inside the bank with the board, and be ready to move as you feel you need to move. So, it's not set it and forget it. Just remember that we're not in that mode. We're supposed to be looking at that on a quarterly basis. And so, one thing I'll just encourage you, please don't get overly focused on the tariff impact. We don't know where that will be. It will likely affect the supply chain adversely like COVID did. But it's too early to tell where that's coming. So I would encourage you to focus on the cracks and the things in credit risk that already existed. And then let's watch. We'll start getting some thoughtful analysis and discussion about the impact of that. But right now it's very, very premature. So, those are my thoughts on it. I tried to put a few things, just that kind of a bullet point on that
Absolutely.
next slide, and just talking about that as you work through there, just be ready. And I forgot to mention, we did see one other trend that happened this past fiscal year, and that is if you compare the loan disclosures and the financials on the first year of COVID to the most recent year, there has been an expectation that you will, move away from kind of boilerplate first time. We sort of copied each other and we put the same thing. Well, now there's an expectation that you don't necessarily need to go longer, but it should be more specific to what you're actually doing. And so the disclosure is going to continue to get refined a little bit. And I'd be remiss if I told you need to spend a little time with your external auditors too, just to make sure that everybody's on the same page moving forward with disclosure, because I think the disclosure will get, quite honestly, better, more refined, more detailed to your institution. So
That's great. Well, we do actually have a couple of questions that have come in. One was, just since we're talking about it, Katie, I'll get to yours next here. Do most banks validate with internal staff or hire a third party?
So the regulatory guidance on any model validation. So this is interest rate risk, your BSA, anti-money laundering models, all models. when you talk about model validation, it should be done by two people with two things. Number one, independent of the function, and number two, knowledgeable, adequately knowledgeable to do it. And so usually the people that are the most knowledgeable inside the bank are also involved. So therefore, it's difficult to do that and satisfy the regulatory expectations. And you could just Google OCC, OFR, any FDIC model validation, and you'll see this generally. So that's why it's often outsourced. However, if you had someone in the bank that had the skill set that was able to follow through and understand that and is independent of the actual function of it, then it's okay to do internally.
Yeah, and thanks, Paul, and thanks, Luis, for the question. And again, to that end, that's one of the reasons we built Steve built the parallel Excel tool, so that if you did have staff members who are independent of the function but knowledgeable enough, they could utilize that to verify with the CECL tool, CECLSolver, the calculations that are being performed.
Right.
The second question that came in was around available for sale securities. Have you seen much for credit loss on AFS, and how is that being calculated? Understanding is that credit loss is to be calculated using debt service coverage. If we are not certain on cash flows, can we use collateralized method in the meantime?
So the answer to that is no, we haven't seen very much. In fact, I'm not sure that I could point you to any examples of setting up a reserve against the AFS securities. And that's primarily because most of the securities themselves are, government agency or some other function like that, treasuries. And so about the only area that you might look at is if you have AFS corporate bonds or AFS municipals. Most of the municipals were well entrenched into a cycle that we do an annual credit analysis on those. And so, first of all, we're talking about a very, very limited set of circumstances that you would probably get to that. And then I'm not sure how I could answer the best way without knowing which type of security. So if it's a mortgage-backed security, then you would look at the pools and probably look at the underlying collateral and be focused on the collateral and performance of the collateral. If you were looking at a municipal, you're probably going to do research on that particular municipality and look at cash flows and the economic factors around that city or entity. So I think you would probably have to shape the way you measure to the particulars of the security.
Yeah, and I think just as a follow-up to that, again, I'd certainly my first go-to, I was actually having a conversation around this with a bank yesterday, and they rightly so, and I agree, is go back to who your broker who sold you that, right? Because they should have analysis that they're either performing themselves or at least have access to something they can give you. So I think certainly that's where my start would be. A second question came in, or a third question: who are some common firms used for validation review of the CECL model? Certainly Paul's firm, Saltmarsh, is available to do that. I think for us, we see a lot, oftentimes it's your current auditor, and again, we do provide, will provide access to those accounting firms to do the work if they need to. But certainly Paul's firm is familiar with CECLSolver. Certainly you're all familiar with Paul, but Paul, I don't know if you want to touch on, kind of how you guys have approach and model validation review work you do currently at Saltmarsh.
Yeah, well, I would just point out to most folks to check with their current provider for external audit is a little bit of a problem because of independence. The external auditors may not be able to do that for you. But if you outsource internal audit or compliance reviews to a firm, you could check with them. And then thank you, Sean, for the plug. We do that, and we did that. We began doing those primarily out of requests from our clients as they started implementing CECL. And so we do that, but we're certainly we're not the only firm around. I would check with your current provider and see if you do that. we'd certainly be happy to, share any of our experiences with anyone if they're, interested in that or would like to ask any questions about what they're seeing in their local market and so forth. But it's very similar to model validation and other models that, when we do BSA anti-money laundering model validation or interest rate or liquidity, a very similar process. We're checking the data inputs, the assumptions, the governance, the output, and so forth. And then I'll point out, management is already going to be looking to the model vendor to provide the information that the model vendor provides. So that's step one, but you still have to go through the rest of model validation, the way you
Right.
use the model.
That's right. And we do have our SOC 1 out there for
Yeah.
our user. A follow-up question, the next question came in. Do privately owned community banks have to disclose CECL verbiage in their financials?
Well, when you say privately owned, I mean, there's no distinction in GAAP. CECL is a GAAP pronouncement. And so GAAP pronouncements require disclosure in financial statements that are considered auditing in accordance with government auditing standards and fairly presented. So certainly you're going to see probably more disclosure in a public company's financial statements, but even a private company would have to disclose, their notes of financial statements, the disclosure that's required under the accounting standard. So the accounting standard is not unique to public companies.
Well, all right. All right. So, I think we've talked a little bit about how should that impact your CECL process and approach, but certainly still more to continue the conversation. Again, just, kind of the idea of planning and preparing for a credit cycle versus in maintenance versus implementation. Paul, you want to touch on any of these bullet points?
Yeah, I think we talked about this. We really encourage you to be having an active, healthy discussion inside the senior management team and with the board about how, some of these changes and uncertainty in the economy are likely to run through or impact your CECL calculation. And like Steve said, be prepared for a shift because, we're going to have a little bit more charge-offs. And so you're going to have to decide, does that charge off have an impact on qualitative or not? Why? What is my outlook on that? I would be paying a lot of attention to peer analysis and media coverage right now. I've personally spoken to representatives of the Federal Reserve and the FDIC and the OCC about what happened through the storm damage that we recently had and their expectations on CECL, and now with big changes in our domestic economy and perhaps global. And so I think they're all looking to you to put together some thoughtful analysis of how this impacts your bank and your loan portfolio. So I'd encourage you to be spending a lot of time with that. And then lastly, boy, we don't need any slippage in underwriting standards these days. So I would definitely be having folks from the loan and underwriting staff in those discussions and making sure we're all sort of on the same pace, matched up to our risk profile and our institution.
Fantastic. Again, I don't know if there's any, I mean, you've been covering a lot of this, but I know there's a bullet here on just loan stress testing. Anything you want to touch on here, Paul?
Well, in the same way that we did storm damage, we looked at the large credits that are in geographic markets that are likely to have storm damage and looking at those borrowers and re-looking at at a credit spread and looking at the analysis of those. As we move forward with tariffs and some of these other issues, you might be looking at the individual industries in your market that might likely be more affected by supply chain disruption or other things from the tariffs and inflationary pressures, and do a little bit of a mini stress test on those particular borrowers and those particular industries. It's very difficult, John, as you know, to spread something like tariffs across the whole loan portfolio. It doesn't affect all borrowers equally. So I would be encouraging you to be thinking about that. And then for maintenance, just those last points, just make sure you got your processes and procedures in place. Everybody has on the same plane. Hey, when are we going to do model validation? How often are we going to check mapping? Let's look at qualitative controls, factors, and how is that going to change? So I'd just be ready. There's a lot of uncertainty. So I guess be prepared is our message, Sean.
Absolutely.
A couple notes, notes from the field, if you will, from what I have seen when it comes to some of this kind of switching to a maintenance kind of plan from initial implementation. Paul mentioned a lot about your processes and procedures for validation, but also for mapping and data. The one piece of information that our tool uses, which is not publicly available, are the weighted average remaining maturity calculations, right? By pool for each of the pools in your portfolio, which is critical for CECL, whether you're using the WARM method or any method. You need to get an idea of what the average remaining life of the portfolio is. And one thing that we see relatively frequently is if there's been some sort of change in how you map or manipulate your data once you get it, or even if you're getting something differently from your core than you used to. If, for example, if you have a new loan type or a new tweak of a loan type, and then when you request that data from your core, whether you're calculating your WARMs or whether you're sending it to us and we're doing it for you, some of those fields from the core poll might not be coming in the same way as other loans that you thought were in the same pool. For example, things that are notoriously challenging are lines of credit, right? The types of loans that don't necessarily have a typical stated maturity. How the core handles it, what core you're using, how the core changes how they handle it, your extract from there, how you send to us, all those things can change. For example, we've seen a core decide just unilaterally to, instead of putting NAs for stated maturity dates for these lines of credit, they started using 12/31/99. And so obviously, without double checking it, all of a sudden you're going to be having 80-year average remaining lives of these lines of credit that have nothing like that, because of just a way that they change. Maybe they go from 0 to NA or NA to blank in the core extract, and then it gets treated differently. So it's just something to keep an eye out for on a somewhat ongoing basis, especially for those loan types that might be tricky from a data translation from one system to the next standpoint. Now, of course, we do everything we can to catch those kinds of things. We catch them frequently. Well, we'll notice something obvious, or we'll notice an entire loan type seems to have a ton of maturities at the exact same date, which seem irrational. And if we're calculating your WARMs for you, we'll certainly alert you to that fact. But that's something that everyone should be having somebody at the bank that keeps an eye on. And once we calculate WARMs for you, if you're some of our users that we do it for, we send you that entire Excel file back with all the loans sorted by loan type, and you can sort those by maturity date right in that Excel file and just not double check our work, but double check that the data that you sent us is now being presented faithfully in the, after the manipulations that we've done to calculate your WARMs for you. So just a kind of a heads up there.
Dave, that's a great comment. I know kind of a best practice that instead of trying to get overwhelmed of matching every single data field in the thing, on a monthly or quarterly basis, somebody takes an hour or two, they download the portfolio, they sort it on either maturity date or maybe interest rate, highest to lowest, and all of a sudden you go, why do I have an interest rate of 0.5, or why do I have one for 27%? So it's not that you have to check every data field, but certainly when a new product, a change in the product features, and then just periodically somebody actually saying, I need to do this once a month, once a quarter, this is the person that's going to do it, and they're looking at a sample or a particular data field, and then simply, if you document that, your auditors and examiners will actually, probably pat you on the back, give you a little star. So
It's a
I would
great
encourage you to
control
be putting those processes in place. Yeah.
And it can be done very much on an automated basis. I mean, you can pick a sample or you get it in some sort of a format like a spreadsheet where you can just click sort low to high, and you look at the top 10 and the
Yep.
bottom 10. And if nothing, you've done an outlier check, and that's a great control. That catches
Absolutely.
90% of these issues just doing that.
Yeah,
Absolutely.
and I think dovetails nicely again with what we heard from the OCC and our exit was just their overall concern too, just around credit administration and just kind of continually monitoring the loan portfolio for albeit just input mistakes or potential
Right.
mapping errors, but also too just making sure borrowers have updated financials, tax returns, just all the necessary blocking and tackling that we need to, and we do to manage our portfolios.
Absolutely.
Another question. Good morning, Nate. Came in. Where should AFS allocations be made in CECLSolver? We have one that has been downgraded to non-investment grade. Individually assessed loans. So Steve, I would say we would use it still within the HTM securities in those line items underneath it, wouldn't you?
Yeah, I mean, we focus, I mean, we call that section, that tab, HTM securities, because the small percentage of community banks that have any issue from a CECL standpoint or reserve calculation with credit losses with securities would be in HTM securities. We're talking about the 1% of you that have any sort of issue here. It's typically within HTM, but if it is AFS, I would use the holding pen that we have, so to speak, in the tool for just securities. There's nothing specific to HTM securities about that tab, right? It's just kind of a basic template that you can fill in the data so that it gets captured within the tool in some shape or form.
Yeah, and I think that's the spot too, right? As Steve pointed out, right? Because again, just making sure you're evaluating it and making any notes or comments, you can kind of capture it all right there. Whether or not there's a reserve required or not, you can at least again demonstrate that you at least are evaluating and monitoring, that particular security.
I mean, in fact,
Okay.
we could remove the HTM and just call it securities. We just did that to kind of lead people towards this is, if you're going to have an issue, it's probably going to be HTM. So we kind of led everyone down there.
Good point.
As we typically do on these, again, kind of a laundry list of things that have been updated at the top. You can obviously the Excel-based auditing validation tool that we touched on in the earlier discussions. But we do have a couple of new tools that are there. And so we've touched on a few of these in the past. But Steve, if you want to go ahead and talk through the scenario organization and management tool first.
Yeah, and I want to go ahead and just demo it. It's live now. We've had a bunch of users using it over the last couple weeks, and so I'm going to go ahead and share my screen here. Give me a second. And we've gotten some good ideas and feedback from how that scenario manager works. So we're going to make a couple little additional tweaks to make everything more intuitive and obvious to everyone. But I want to share what we've done, and I'll show you what we're going to do. It should be, where is it?
All right, I see it.
Okay, so this is what the screen looks like as of today. If I logged in to the CECLSolver, just on my overview page, you'll notice that there used to be a drop-down list of all your scenarios, just kind of one drop-down list with no real organization to it, and then a save scenario or save as new kind of scenario buttons right here. So now it's all housed within the new scenario manager. So if I click on this, you'll notice that all of my scenarios are organized by year. So some of the older ones, and part of this was a result of a lot of you guys have been with us for a long time, and you have tons of scenarios at this point. And obviously the more recent ones are going to be more relevant to you. Every once in a while, you want to pull back one from a year ago so you can compare and contrast, but we wanted to organize it by date. And if I expand 2025, these are all the scenarios that we build internally here. It'll let you know when the scenario was initially created and who by what username at your bank. And then when it was last updated, if it was updated, since it had been originally created, and who did the updating. So if I want to pull up one of these scenarios, let's just say a test that I did, I'll click select. You'll notice it gets highlighted yellow, and in the background, it's pulling up. So that scenario is being loaded right now. So there we go. So now that scenario is loaded. It says right here, the selected scenario is Steve H test, and I can do anything I want here. I can continue to update it for the next quarter, do any of the things you would typically do on a quarterly basis. When it's time to save it as a new scenario, let's say I pulled up last quarter's, I've made all my changes, and I'm ready to go ahead and save it. I'll go back to the blue button here, and my highlighted scenario, you notice this one says resave now. So I can open up another scenario and they just say select the scenario, but the one I'm currently using is highlighted and it allows me to resave. Now, if I've changed anything, it's going to give me a warning to say, hey, you're overwriting on top of this old scenario. Do you want to do that? And you say, well, yes, I was halfway through the scenario. I'm just finishing it. I want to save this on top of what I had before, and that's fine. Or, well, I changed a bunch of stuff. This is ready for the next quarter. You're not going to resave it because then you lose last quarter scenario. You're going to save it as a new scenario right here. So I want to save these changes to a new scenario. I'm going to give it a new name, aptly named Steve Test 2, and click save. So now it says Steve Test 2, and I'm working on this newer scenario. So as you go here, if you're updating scenarios, just remember before you go anywhere else on the system, and typically, I know there's some issues sometimes with pop-up blockers in browsers, but the system is designed such that if you try to go anywhere else and you're updating, let's say I'm updating a scenario and I've made changes and I want to go somewhere else, leave site, ? Changes you made might not be saved. So I do not want to leave. I want to cancel and continue working on it or save it. So that's just a friendly reminder. Sometimes those pop-up blockers block them. So every once in a while, you might not get that extra kind of backup. So just make sure that when you're done with your work, you click on this and then you can resave your scenario. If you resave scenario, it will overwrite the older version. That's fine. We are adding a button right here early next week that just says save, so that if you're kind of saving your work as you go, if you're one of those people who's always worried that your internet will cut off or your computer will shut off or something weird will happen and you want to save every 10, 15, 20 minutes, like a lot of people do, then instead of clicking on this and then finding your scenario and then going over to resave, we wanted to make it even quicker so you can just kind of click one button as you go. So there'll be a button here, a green button that just says save come next week. And as you're working, you can just periodically click the save button and that'll make it kind of a little more intuitive. But that's how the new scenario manager works. If anyone has any more feedback or things they like about it or don't like about it, please shoot us in our inbox or let us know one way or the other as we continue to try to make it as user-friendly and intuitive as possible. John?
Thanks, Steve. We got a couple other questions. Nate had a follow-up questions. We have separate GLs for unfunded commitments and HTM. I'm not recalling if accounting standard requires a GL for AF for available for sale. And I think it's probably more directed to Paul too. But
actually, check this out. I wouldn't say I anticipated the question, but while on the balance sheet, right, on the asset side of the balance sheet, on your call report, there is the contra asset account for the loan portfolio is right there. It's always been there, right? The loan loss, you've got your gross loans and your loan loss reserve and then your net loans. And then on the bottom side of the balance sheet, on your liabilities, there is a call report line item for reserve for unfunded commitments. However, on the securities part of the balance sheet, it just asks for the net, right? The net after any reserve account. However, in another sneaky little schedule of the call report, RIB Part 2, changes in allowance for credit losses. There is a column for held to maturity securities and a column for available for sale debt securities. And it does ask you for provisions for credit losses and beginning and ending reserve amount for them separately. So while it's not on the balance sheet, it is in schedule RIB here. It does ask for those values. So if you wanted to, kind of reverse into what the securities values would be on the balance sheet before the not net gross of the reserves, you can kind of back it out this way. But yeah, it is asked for, just not, it's not on schedule RC, where I believe it says right here under securities, these things, footnote 3 probably says net of any applicable allowance from credit losses, which you would have to fill out in RIB Part 2. Paul, what did I miss?
Yeah, Paul, anything to follow on that?
There for GAAP financials, the credit losses, which come from loans or held to maturity or available for sale, are all grouped together on the audited financials. However, as you pointed out, Steve, the regulators have a pretty high level of interest in breaking that reserve into those three pieces: loans, held to maturity, and AFS. So we would normally say, yeah, open up a GL account and track that separately for each of those three types. But in the audited financials, it's just going to go in. So your provision, current provision for credit losses would include credit losses from any one of those three, and your provision for losses in unfunded commitments is listed separately for an off-balance sheet. And so the loan commitments goes in a separate line on the income statement and goes in liabilities. The expense related to credit losses goes into credit losses on the income statement, and then would go into the total ACL. But we would encourage you to break those into separate GL accounts if you expect to have them. Again, so few people are expecting to have them. A lot of people haven't done that. But as you pointed out, the call report does have some fields for that. So it'd be much easier to trap those in individual GL or sub GL accounts.
Yep. Thank you. We had another question come in. What types of loans do you typically put under the individually assessed? Are these watch list credits?
Probably not necessarily watch list. It's typically loans that we used to call impaired is probably the most likely ones that you're going to see in there. But, you know, the accounting pronouncement says any loan that should be individually evaluated because it does not have the same credit risk as the pool. So it has unique. So you could define that very specifically or more, very broadly, but I would have to say probably it would be loans that you would have previously called impaired. So those are usually at a worse adverse classification than watch. They're usually the ones probably that would be substandard in the old terms, so forth. So there's not one right or wrong answer to that, Sean. It's your judgment, but I would say there's a lot of watch list loans that really don't show a lot of impairment. The management team just wants to watch them.
And especially with keeping in mind that the historical data that we typically use to calculate historical lifetime losses on our collective pools includes losses, or is made up very much so of losses that came from loans that would have been at least watch list historically anyway. And so we want to make sure we're not double counting. We're not taking any loan that has any sort of hair whatsoever on it and individually assessing it and having our collective pools be only the 100% perfectly pristine ones, then assuming losses on those pristine ones from our historical trends and our peers' historical trends, and then adding individually assessed on top of it. We're going to end up overestimating the expected losses on those loans. But as Paul was saying, it's completely subjective. Your loans have to be put into pools that have similar enough risk characteristics. So really, an individually assessed loan is simply a pool of one, right? It's a loan that it's different enough that you cannot honestly keep it in the same pool as the others.
All right. Next up is we've touched on this, I think, in the previous coffee talk, but I think echoing a little bit of Paul's earlier comments about looking at peer data. We've obviously always had some peer data within CECLSolver, but we decided that it would be additive to incorporate what we think is really great peer analysis from our stress test and use it as well here in the CECLSolver. So Steve, if you want to just again kind of touch on what we're building here.
I think Zoom now allows multiple people sharing at the same time. So I'm not sure what everyone else's screen looks like. He's sharing a screenshot of it. I'm going to share it live. So I don't know if you want to unshare yours so people are sure they're looking at the right thing.
Yep.
I don't know if that was a improvement or not, honestly, on the system. Can everyone see my
hey,
screen
Steve,
now?
before you go there, just one reminder on the scenario management tool. Up there in the helpful hints, you can also see that we have a video that Steve put together as well. So
Yeah, this pretty much goes through exactly what I just shared with you guys
Yeah.
on the screen as a separate Loom video. So if everyone can see my screen still, I'm going to go ahead
Yep.
and so in the peer data section, let me hold on, let me go ahead and pull up some real warms here. Oh, by the way, everything's updated for 331. The regulatory study data for peer warms is updated for 331 already. The CECLSolver user data is all updated for 331. I'll go ahead and show you guys that. Oh, you know what? I'm using the wrong tab here. So one thing I want to show you guys, which is on the front burner now that we're working on, is in addition to our typical, these are weighted average loss rates for your peer group. So if this is QCBI Maine, meaning all the community banks in the state of Maine as a peer group, and I'm looking at the peers loss trends over the long term, and the highlighted periods match your warms or your look back periods. And so we can calculate lifetime losses for the peer groups on an apples to apples basis. All these data points are weighted averages of the banks in the peer group. What Sean was alluding to was one thing that a lot of our users really like about our credit stress testing tool is the ability to sort of stress the peer losses going back in time and see what those loss trends would have looked like. Maybe not at the weighted average or median level, but at the 75th or 90th or even 95th percentile. It's just another way to get more peer data that's maybe not average peer data, if you feel the need to stress losses to look for higher reserves or justify higher reserves or whatnot. So we're going to be adding, this is not live yet, we're going to be adding another tab here where you can toggle over to a percentile rank. So for example, it starts at median with its 50th percentile. Now, I'm not going to get too deep into the math of it, but median loss rates are pretty much zero for most, for any large peer group. Why? Because if you're going to have losses, you're not going to have them evenly throughout your portfolio. You're going to have one spot where you see your losses, but the majority, more than half of the banks in the peer group, are probably still going to have zero in that particular segment. So you see lots of zeros at the median. However, once you start bumping it up to the, let's say, 75th percentile. So when I typed in 75th percentile, every single peer value, all the annual years going back in time, and the lifetime loss rate calculated here, recalculate on the fly millions of data points to become 75th percentile values. If you want to stress it even more, 90th percentile. You'll notice every one of these values just bumped up significantly. And if you want to kind of customize something, you can say, I'm going to take median loss rates for these particular segments, but I know my examiner has got, really wants me to be conservative when it comes to CRE, given issues we might have had during the last recession or some sort of focus that we have and concentration in that particular segment. So you can come in here and say, I'm going to do 60th percentile across the board, but for my non-farm, non-residential, I'm going to be really conservative and bump those peer loss rates up to 90th. So you can type in a separate loss percentile rank for each individual segment and have that segment recalculate across the board. So it's not replacing anything in the tool. If you're comfortable with your Q factors, if you like the peer data you're getting, you don't have to do anything differently. All the peer data is just for reference, right? It doesn't, when you change your peer data, when you change something in this section here, it doesn't change your calculation of reserves at all. It just gives you different reference data to justify potential Q factors adjustments or whatnot. So we're just giving you another option here where you can find some different loss rates at a higher percentile or lower percentile in order to help under your examiners and auditors understand your thoughts and reasoning behind your adjustments. John?
Great. Thanks, Steve. Another question around individually assessed loans. Good morning, BB. What about the impaired loans, quote unquote bankruptcy, but that are not collateral dependent? Paul, how would you think of reporting those?
If I understand, you still have a loan that you want to watch and independently evaluate, but under
Yep.
bankruptcy, then you would look at it's basically a cash flow, present value of cash flows calculation then instead of collateral. So I'm not sure if that was the answer that you really are either looking at cash flows or collateral dependency as the two primary methods.
But they could still then should report those in the individually assessed section.
But yeah, unless you have a whole
Yeah.
pool of bankruptcy
right.
loans.
Yeah, and you can, by the way, you can pool individually assessed type. Well, let me
Right.
try to explain that. If you have a bunch of loans that are problematic, but they have the same characteristics because it's from some portfolio you acquired or some very specific thing that's happened to a group of them, you can pool them together still. You don't have to individually assess them just because they have issues. They have the same issues.
Yeah, fair enough. Is the Steve? I think you maybe just again the current peer calculation's not at the 100th percentile; it's the weighted average, correct?
Yeah, no, 100th percentile would mean, so the percentiles, what that means is what percent of, if you rank them all, right? If the loss rates of your peers go from 0% for the best peer to 3.5% net charge-offs for the highest or worst peer, median would be what loss rate has half your peers below it and half your peers above it. If you choose 90th percentile, that means that loss rate is worse than or higher than 90% of your peers. So the way we do it now, the weighted average, if this was 100th percentile, each one of these values would be the worst single net charge off of any bank in your peer group. And that's not what we're doing here. So while, you know, there's typical averages, right? Your standard mean, and then your median, which is your 50th percentile, half above and half below. Then there's a weighted average. And that's what we did here for our existing methodology, is doing a weighted average, which if you think about the different methods, this is a really good use of weighted averages, because when you're considering losses in your market, it's less important what the specific ratios are of each of your individual peers. What you want to know is how many loans of this type are in my market, and how many of those, all of those loans, what percent went bad, how many of them went bad, right? And to what extent. So that's a perfect use for weighted average, but which is why we've gone with it. But again, this just gives you the ability, you can't really stress a weighted average, right? In any objective fashion. So that's why we switched to the percentile rank for this other methodology, so that you could stress it.
All right, we're up on the hour, so I think we'll probably move through these last slides again a little bit more quickly. But again, Steve just touched on the data, and the stress test is updated again from segment level reporting that Steve shares with you. We've built a pretty big database of both scenarios in our banks. But Steve, I don't know if you want to touch on any of these trends.
Yeah, we've been following this. We've been aggregating all this data from all of our users for a good while now, and presenting that data to you guys to help, and really getting it before it's actually even public. So right now you have all the data that our users, all the scenarios that our users have run during the first quarter. So you can pull it up now and look at 1Q25. So all the scenarios that were run between January 1st and March 31st of this year, and see what direction worms are going in by segment, what direction Q factors and what direction collective pool reserves have been going in amongst all of our users. And you can look at it at the 25th, 50th, or 75th percentile. So you can kind of get a range. And this is, again, helps with Q factors. It helps with a sanity check to make sure that, this could go back to your data, right? If you go and look at your WARM, and your WARM is gone way up, and then for multifamily loans, you come here and you see that for everyone else using the tool, for the other 400 banks, it's going down. That might be a reason to double check and see if there was an assumption or some data that got changed or out of whack. So it just kind of helps you with some guardrails and peer data and everything else.
Great. Just some again, further work that Steve does around industry trends.
We shared this 2 quarters right after it came out in February, but I'm just reminding everyone, this backs up everything that Paul has mentioned up to this point. We are certainly seeing deterioration in credit quality. It's not making itself to the net charge-offs yet amongst banks. It is consumer loans in the credit union space. It is making its way into net charge-offs, but for commercial banks on the whole, we look as far upstream as we can as far as call report data, right? And that's 30 to 89 days. And as you can see, on those little spark lines, those trend lines on the right, the red dot is the highest level in the last couple of years. And for almost every segment, well, it's the highest right now as it's been for past dues in each segment. If you scroll down to the next one, non-accruals, same thing, right? And we look at 50th percentile and 75th percentile, so you can see trends. Yeah, for example, non-farm, non-residential median non-accruals are still pretty much flat, but looking at the 75th percentile, we are seeing an increase as well. And then the last one, charge-offs. These are gross charge-offs. Again, looking for those trends, and we haven't seen too much of it yet, but we're seeing a little bit with charge-offs particularly. There's a cyclicality, right? An annual seasonality to how people report their charge-offs. And so you like to compare the same quarter this year to the same quarter last year. So that's why I've highlighted fourth quarter 23 and fourth quarter 24. And you can certainly see there is a trend in the making heading up. And then a couple things I showed you. Oh yeah, we've talked about this. Interestingly, there is one region of the country that has significantly lower reserves than any other region, and that is the Northeast. Most other regions, not surprisingly, the West is on the high end, but they're converging pretty closely, except for Northeastern community banks, where they have a significantly lower reserve than any other region. And just real briefly, so I said, yeah, don't just take our word for it. So we show you all these trends that were in reserves and losses and everything else from our huge internal database, but you can always just go right to in QwickAnalytics. There's an industry research page where you can go to and track anything you want at any level of granularity for any combination of peer groups and individual banks. It's a great tool that we are working significantly on further enhancing. So it's going to have a lot more good functionality as we go through this year. But right now, just to give you an example, looking at reserves, I pulled up reserves for the gray line is all the community banks in Georgia, and the purple one is just UBPR peer group 5, right? Those 1,200 banks in the 300 to a billion. And you can see reserves are been kind of flat over the last 3 years. But then on the next slide, interestingly, we see that non-performing loans as a percentage of total loans, while they were coming down for a while, they have certainly started coming up in the last 2.5, 3 years. So the result is, on the last slide, not surprisingly, this is a long-term analysis of reserve as a percentage of reserve to non-performers, right? Something that we're going to be looking at a lot more over the next couple of years, I guarantee it. The green line is just Camden National Bank up in Maine, our guinea pig bank, but those two other trends, you see that reserves to non-performers had been increasing consistently for over a decade, and has started coming down significantly in the last couple of years. And that trend is, at this point, accelerating because we're going to continue to see non-performers increase. And so far, we have not really seen the associated reserves increase. So just another way to do that type of analysis within our platform.
And I think too, just as you can see, right, it makes great filler, if you will, for any presentations you're making to your board to put in your analysis just to demonstrate what you're looking at and trends you are seeing and monitoring.
And you can do that over any periods. If you haven't played with this tool yet, it's an awesome tool on the website. It's really interactive. You can look over, change it from 2 years to 15 years and change it to quarters. You can add 2 or 3 or 4 peer groups simultaneously. So you can have, your bank and maybe one other peer that you guys compare yourself to down the road. And then like a state peer group and a national peer group and a regional peer group. You can put them all on the same chart and change loan types and everything else. There's a lot of really good interactive use you can get out of this tool.
Yeah, and again, this can be found in the data and research section on your homepage, tab industry research.
And the economic data is there as well. You can overlay any of the economic trends that we have right on top of those asset quality charts.
Perfect. Just a final reminder, if you have any other questions, go ahead and submit those now. Again, we want to thank Paul for joining us. Again, if you need any help with third-party validation, Saltmarsh is a great partner, and and certainly all of you have gotten to know Paul over these coffee talks. You may have already known him before, but they're certainly standing by, and we're certainly willing to talk to you and see if they can help. Any final comments, Paul, Steve, for everyone before we let them off to their Friday?
No, I think we've covered a lot. So hunker down, everybody. We're 2025 is probably going to be a little bit bumpy, but I think we'll get through it just fine. But just have to pay attention, right?
Yeah. Amen. Amen. Just a final reminder, certainly if you want to get more granular, we talked about getting even, deeper details. IntelliCredit, our division of, can certainly assist you with that, more data analysis through their portfolio analytical tool. We don't want you to take our word for it. Take us up on a 3-month trial. We will show you how we can help give you both better insight, but also potentially better reporting on your portfolio. A couple of webinars coming up here in April. Jumpstart cost-effective small business growth. We'll have that on next Friday on the 11th. And then on the 25th, we'll be back for a loan level stress test, coffee talk on April 25th. So certainly, again, register for these. You will get a copy of the slide deck and a link to the recording. So it's always worthwhile to register, even if you cannot attend. We'll be back for our CECL coffee talk on May 16th. So again, certainly encourage you. Thank you for joining us today, but certainly encourage you to register for that one as well. And so again, Steve, any final comments before we let everybody go?
Nope, I'm good.
All right. Paul, any final words?
No, thank you for having me. I enjoyed it.
Always thank you for joining us. Appreciate everybody's time today. We hope you have a great weekend. Let me make sure there's not one final question. Thank you, Oasis. So thank you all for joining us, and we will see you next month. Have a great weekend.
Thanks, everybody.
Thank you.